The 2025 tax reform bills under President Bola Tinubu have introduced a paradigm shift in Nigeria's fiscal federalism, primarily through the recalibration of the value-added tax (VAT) sharing formula and the modernization of corporate incentives. Historically, VAT distribution was heavily skewed toward the location of a company's headquarters, often favoring the southwest, specifically Lagos, and the north-central, Abuja, where most corporate entities are registered. The new derivation-based model, which shifts the emphasis to the location of consumption rather than remittance, serves as a significant economic equalizer for the southeast and south-south zones. These regions, which boast high consumer density and vibrant retail markets, are now seeing a direct surge in their monthly federal allocations, as the VAT generated from their local markets remains within their regional development pools rather than being exported to corporate headquarters in other states. In the northern geopolitical zones, the northwest, northeast, and north-central, the 2025 reforms have made strategic concessions to balance the perceived risks of the new VAT model. By exempting essential agricultural inputs, livestock, and small-scale farming businesses from the newly introduced development levy and providing a 5-year tax holiday for agribusinesses, the administration has effectively shielded the agrarian heartland of the country from increased operational costs. This has fostered a localized industrial boom in zones like the Northwest, where processing plants for crops like rice and tomatoes are springing up under the tax-exempt status. Furthermore, the inclusion of federal character in the leadership of the new by increasing the derivation component of VAT to 60%, the administration has effectively ended the era of rent-seeking, a behavior where states relied solely on oil windfalls. Now, every geopolitical zone is incentivized to improve its business environment to attract consumers and businesses alike. This simultaneous pressure and support, protecting the poor through a 800,000 naira tax-free threshold while demanding more from high-earning entities, has created a more resilient national economy. The result is a Nigeria where the North finds strength in its agricultural tax shields, the South thrives through industrial efficiency, and the East grows through SME formalization, all contributing to a unified revenue base that is less volatile and more equitable than at any point since 1960. Under the 2025 Tax Reform Acts, the distinction between tax exemptions for business owners in the North and South is primarily driven by the sectoral incentive and small company frameworks, which align with each region's economic strengths. In the North, where the economy is heavily agrarian, business owners benefit from a monumental 5-year tax holiday specifically for primary agricultural production, crop, livestock, and dairy, alongside a 100% tax exemption on interest for bank loans used for agricultural fabrication or cottage industries. Furthermore, essential agricultural inputs like fertilizers, seeds, and equipment are now zero-rated for VAT, effectively lowering the cost of production in the nation's food basket. Conversely, business owners in the South, particularly in the bustling commercial hubs of the Southeast and Southwest,